Okay, let's have a look. We'll hear the announcement of it first.
Prime Minister Mark Carney has announced a new initiative that he says will help establish economic independence for Canada. It's being dubbed the Canada Strong Fund and will act as an investment vehicle for major new projects. Essentially, Canadians will be able to invest in the fund and share in its returns.
How does that work? Start a new chat here. I don't really like the voice mode in Claw. Try this. I hear that Canada has a... Not picking me up at all. Is this a problem with the settings or a problem on their side? Select default microphone. It was on my side. That one. I hear Canada has a sovereign wealth fund that they're creating, and that Canadian citizens are going to be able to participate. What is that going to look like? Let's let it think.
In unveiling the initiative, Carney said, quote, "Many of Canada's former strengths, built on our close ties with the U.S., have become our weaknesses." Here's more of what he had to say.
So here's how it works. A sovereign wealth fund is essentially a national savings and investment account. It's designed to grow wealth for future generations of Canadians.
Yeah, but it's usually best to create the sovereign wealth fund with excess capital. Like when you're, just checking somewhere here. When you have a surplus, putting that surplus into a sovereign wealth fund is a really good idea. Putting, like, as far as I understand, like, the current government is running a massive deficit. And so they're trying to create an investment fund while essentially doing this on interest. Like they're doing it on debt. I guess we'll see more of that tomorrow when the public statement, because I'll let him talk, but I'm pretty sure he goes into that the economy, the economics of the country, we're actually doing pretty well right now. But I still see a large deficit. I'm not sure how that's possible.
Many countries that are blessed with natural resources, like Norway, have sovereign wealth funds. Canada hasn't had one until now. The new Canada Strong Fund will give all Canadians a direct stake in building Canada strong.
This announcement comes just before the spring economic update, which will happen tomorrow. The CBC's Rafi Boudjikanian joins us live from our parliamentary bureau with more. So, Rafi, this fund will begin with an initial investment by the government of $25 billion. Where is this money going to come from, and how will it be used?
That part about where it will come from is still a little bit of a
that's kind of an important question.
Question today, Hillary. We do know the government nodded toward the spring economic statement when asked about that, basically saying stay tuned. We also heard...
Yeah, they're basically saying wait till tomorrow where we can give you the spring economic statement.
That the government says it's one of the only two G7 countries that can borrow at low cost internationally. So that gives us perhaps a bit of a hint of where the $25 billion is coming from. As for how it's going to be used, we got a little bit more detail there. The Prime Minister saying that Canadians will also be able to invest in it, of course, and that the government will use the money in conjunction with the private sector in order to build some of these big nation-building projects that this government has been talking about for about a year now. Have a little bit more of a listen to what he had to say.
It is not something for, I'm going to use the term from your question, rich people. It's something for Canadians, for all Canadians, everyday Canadians. And on that,
when you do something like that, it is the rich people that tend to benefit. Let's see. This is actually breaking news. Prime Minister Mark Carney announced it just this morning. Oh, yeah, look at that. Here's what we know so far. What it is. The Canadian Strong Fund is Canada's first national sovereign wealth fund designed to make sure that the returns from national building projects are shared with Canadians. We'll invest in strategic Canadian projects and companies alongside other investors with a clear objective to achieve commercial returns and build the wealth of Canada. Like, this sounds good. Like, is this something that you get to put money into to see returns? Like a stock? I don't know. Let's see. How will it be funded? The fund will be seeded with 25 billion Canadian, about 18.4 billion US from the federal government. It will be professionally managed and independent of the government, meant to invest alongside the private sector in nation-building projects on a fully commercial basis. What will it invest in? The fund will invest in Canada projects and companies driving economic transformation, including clean and conventional energy. I like that one. Critical minerals, agriculture, and infrastructure. Okay, all of those are good. Returns will be reinvested to grow the Canadian Strong Fund and strengthen its capacity over time. Like, this is a really good idea, but it would suck if there was I don't know, like an economic crisis that turned this into a bad idea. Like, it looks like there is on the horizon. How can regular Canadians participate? Individual Canadians can put money into the fund, and Carney suggests it would be similar to purchasing a government bond, where the initial investment is protected. Returns from those investments will be put back into the fund to expand its capacity and build out capital projects in Canada. How will it be structured? The Canadian Strong Fund will operate at arm's length from the government as a new Crown corporation, guided by a CEO and a qualified independent board of directors. This is designed to ensure the fund remains focused on its mission, supporting the transformation of the economy and creating wealth for Canadians. What's the timeline? The Spring Economic Update 2026. Tomorrow will formally announce the government's intention to create the fund. The government will consult over the coming months on the specific design of the retail investment instrument, and further details on the fund's mandate, structure, and implementation plan will be provided in the coming months. Bottom line is that many specific details, like the exact mechanics of how citizens invest, minimum investment amounts, and return structures, are still being worked out. So we got to keep an eye out for tomorrow's Spring Economic Update. Well, this is exciting. I like this.
That scale to provide it, and we'll provide it in a way, again, we'll consult and we'll go through the details, so I don't want to overly finalize it, but we intend to provide it in a way where the investment itself, the actual amount of money, is protected. It's something consistent to buying a government bond, but has the upside, the additional return when these projects realize their potential.
So there you're hearing the Prime Minister essentially explaining that there will be no gatekeeping of regular Canadians being able to invest into this fund.
Like, that's not always a good thing. Like, there was gatekeeping to stop average investors from entering the subprime, like from being able to invest in like subprime mortgages or like the subprime funds, because the risk was considered too high to let ordinary investors do that. Now, when you let the ordinary investors do that, which is what they eventually did, that's when you could have a lot of problems. And there could be some really twisted incentive structures that are built there. But I guess, like, it all depends on how it's structured and how it's set up. Like, sovereign wealth funds have done well. Like, there's been examples of it done well. And it being, like, net positive to a country. So, like, he's clearly, they brought up Norway a couple times. Like, they're clearly looking at a specific model and trying to replicate it. Now, replicate Finland's housing as well, you know? I'd like that. We'll take the sovereign wealth fund idea from Norway, the housing system from Finland. I mean, that's how you build a good country.
Fund. And we also heard from the finance minister today, François-Philippe Champagne, making the rounds before the spring economic update tomorrow, seeming really enthusiastic about this idea the government has.
This is a new tool in our toolkit to make sure that collectively we build our nation, collectively we benefit from the returns, and collectively we can all invest if we want to alongside to build our nation.
Now, though both Champagne and Carney said we will hear a few more details tomorrow, they've also made it clear that there are some questions the government itself is still looking for answers to, such as the exact parameters of how Canadians will be able to invest. They said that they will be consulting with experts on the matter. And we also heard...
It's starting to sound like they don't really have it all set up. They're in the initial stages. They're hinting that tomorrow's spring economic statement will be good to essentially prove that they could spend this money. Which, I mean, that excites me. I mean, our country being fiscally responsible is good. We haven't had that in a while. But I guess we'll probably see more about that tomorrow.
Today that these projects that the fund will be financing are not necessarily the big nation-building projects that the government needs to legislatively get through, right? So last year they enacted this new law that is supposed to get faster approvals for projects the government deems in the national interest. Today, Carney said that those are not the only projects this fund can kick money towards.
Yeah, I mean, you'd want it to have wider access, right? As long as you set the criteria for it well, which is what it looks like they're doing, then giving it more room to be able to accomplish that, like just investing into the specific things the government allows you to, like odds are, let's look at something like AI. I don't know if the government is gonna push AI, but the private sector certainly. And there's a lot going on in that, and so investing into some kind of domestic AI industry would probably be really good. But you want to do that without causing the same. Because in the US, there's so much pushback. Data centers specifically, which are the heart of the AI bubble. But like, you can do data centers responsibly. They don't have to be put beside a residential district in a city. It just so happens that the city currently has the electrical infrastructure to support it, which is why they're there. I think we should be building something like that out on a larger basis somewhere. Okay, well, I guess I certainly am not going to be the one to decide how the 25 billion spent. So let's continue.
Okay, and Rafi, you were also tracking another big political story today. The newly minted Advisory Committee on Canada-U.S. Economic Relations. It is meeting today for the very first time. Some additional names have been tapped to join this group. What can we expect at this inaugural meeting?
I mean, this is the group that's in charge of looking at the future of the Canada-U.S. relationship. And of course, that relationship has been rocky for over a year now with the trade disputes.
Yeah, but like, Trump's not permanent. Don't treat him as a permanent feature of the American system. Like, as far as I understand, like, isn't his approval rating horrible right now? Like, that means most Americans don't agree with him, right? As of today, shows 39% of Americans approve of what he's doing, and a majority, so 57.7, disapprove. Like, that means there's going to be change again in the American system pretty soon. Like, I don't know how much midterms change things, but like, next election, he's not there permanently. But I understand the whole, you have to assume, like, there were Mood-Hawley tariffs. I don't know, way back then where they did this before. Like, this is a cycle that does happen in the US. You do have to prepare for this turn inwards that happens, and tariffs. And so diversifying is good. I mean, pretty much that simple. So currently, Mark Carney's, I don't know, like, I feel like he's taking a more hostile attitude towards the US. And this might be a negotiating tactic because of the CUSMA renegotiations coming up. And so I imagine both sides are currently essentially trying to build their hands for the negotiation. I don't really understand the, like, see if I can find what I was looking at earlier. Somewhere. Was it the last one? Yeah. Carney's declaration, America is now a weakness. Prime Minister America released a video this week that the U.S. has fundamentally changed its approach to trade. I should look into this one as well. Do that one.
It's ongoing between this government and the White House. There was a little bit of a shakeup in the group last week. In are some new names like former Conservative leader Erin O'Toole, former Conservative cabinet minister Lisa Raitt, as well as the chair of the Canadian Chamber of Commerce, Candice Lang. We saw some names removed as well. Think of former Alberta NDP Premier Rachel Notley, former Labour leader Hassan.
At least they appear to be talking now. For the longest time, there was just no movement on the Canada-U.S. trade. Like, they weren't talking about it at all.
Yusuf. Now, this committee in its new configuration is meeting today, just about a couple of months ahead of a projected deadline for Canada.
We're getting off topic.
You need to actually have.
I want to look at the Sovereign Wealth Fund. Okay, so Liberal Slush Fund.
You need to actually have wealth for.
Let's see what Pierre Poilievre says about it.
A sovereign wealth fund. What this Liberal Prime Minister is proposing to do is use the credit card in order to take $25 billion and put it into a Liberal slush fund, Mr. Speaker.
I mean, we don't know that until tomorrow when we get the economic data. If he's funding this with debt, I don't like that. I think you should focus on trying to provide a surplus before you go into like investing. But then he's a banker. Maybe taking out debt and investing is how it's done. Let's continue.
This after the Liberal government doubled the debt and gave us the worst inflation in 40 years. This Prime Minister...
What is our... It's not debt to GDP ratio. It's once you include assets. What is Canada's... You're gonna give me a problem with this too, huh? You know what I probably gotta do? Go to sounds. Probably. Trying to listen to that mic, aren't you? What is Canada's debt to GDP ratio once you take in the assets of the federal government? GDP ratio. There's a specific word for it, but it's escaping me right now. It's okay, I got out of thinking mode. It's gonna continue.
Is spending more taxes, more costs, more of the same. Will he put it all on the nation's credit card again tomorrow?
Minister of Finance.
Mr. Speaker, let me help the Leader of the Opposition. After all, it's Monday. Let me help him, Mr. Speaker. Mr. Speaker, the International Monetary Fund just said last week that Canada has the strongest fiscal position of the G7. Mr. Speaker.
What?
Mr. Speaker, the strongest fiscal fund just said last week that Mr. Speaker, the International Monetary Fund just said last week.
International Monetary Fund said that
Canada is the strongest fiscal position of the G7.
Canada is in the strongest fiscal position of the G7. Current ratio 42.4%. Okay, what is it called? Net. When discussing Canada's debt, net of assets, there are two primary measurements used by the government and economists depending on which assets you include. Okay, federal debt. This is the most common metric used in Canada federal budget. It represents the government's total liabilities minus all assets. Yeah. Minus all assets. Current ratio is 42.4. Like, I mean, it's not bad. I think it's 70%. Once this gets over 70%, you start to see real negative growth in the economy. Like, that's when it starts to become a real pressure. 42.4, like, it's not good, but it's not horrible. Net debt. This measure used by Pacific Canada and the IMF for international comparison represents total liabilities minus financial assets. It does not subtract the value of non-financial assets like government buildings or equipment. Current ratio 31.1%. Key comparisons, metric. Okay. While the federal debt to GDP ratio has increased since 2020, it remains one of the lowest among G7 nations when measured on a net debt basis. Net debt. Okay, let me get the words I'm looking for again.
Canada's the strongest fiscal position of the G7.
International Monetary.
International Monetary.
I hear that the International Monetary Fund has stated that Canada is in the best fiscal position of the G7. Can you go into more detail for me?
Fund just said last week that Canada is the strongest fiscal position of the G7. Mr. Speaker, the Canadian economy has the second fastest growth in the G7, growing almost twice as the one in Germany, almost twice as much as Japan, almost 3 times as our colleagues in Italy, Mr. Speaker. Canadian economy is strong, Mr. Speaker. We're going to build Canada strong together. We're going to have our Canada Strong Fund. Canadians will benefit.
The Honourable Leader.
Like, I can see both positions. Like, I like this idea of a sovereign. Sorry, I'm just looking down at the golden maze. Like, you still see really weird hangovers from because the whole system was built based off the British system, and so the House of Lords in the British system still has a lot of things like this, like a golden mace. I wonder if it serves any purpose. Like, is it raised at any point? Okay. I mean, I can see both sides of the argument. If they're saying we're in a strong monetary position, then now would be the time to create a fund like this. But the issue you have is that if you're creating this fund, you're not using that money to like build houses. You're using it to invest into like a railway, or a pipeline. But like, these could be good investments. But we are in a housing crisis in the country. Cost of living crisis. There's a lot of things I'd like to see him tackle before this, even though I would consider this generally a good thing at the current stage. Like, we don't have details yet. It does depend on the details.
The opposition.
Prime Minister can't answer questions in the House of Commons because he's been wrong on every single major economic issue of our time. And the results are what Canadians are paying for now. More costs, more debt, more taxes, more of the same. In fact, this Prime Minister has given Canada the worst food inflation in the G7, the worst household debt in the G7, the worst housing costs in the G7, the second highest unemployment in the G7.
I mean, like, he's just lining out the negatives that have come.
Tomorrow, he intends to put it all on the national credit card. Trudeau had a $31 billion deficit left over for this year. Will he break through that limit and put that on the national credit card as well?
The Honourable Government House Leader.
Well, Mr. Speaker, inflation has been in the Bank of Canada's target zone and has been for some time, but we are continuously intrigued by this notion about inflationary spending. So we just want to ask and have him answer with absolute clarity, the Leader of the Opposition, is it the Canada Child Benefit that is inflationary? Is it the Canada Disability Benefit? Is it the Canadian Dental Care Plan? Is it the Groceries and Essentials Benefit? Is it Old Age Security? Exactly what is inflationary spending in the eyes of the Leader of the Opposition?
The Honourable Leader of the Opposition.
I don't watch enough of this. Look at these people that just have to like, oh, oh, it's flipping to someone else, we have to stand up now. Like, what is their function? What about these guys?
Well, I'm glad he asked because I got some direct answers. This is how you answer a question. What is inflationary spending? $90 billion for the wasteful Alto project. $1 billion for a gun grab that the public safety minister admits will not stop crime. $20 billion.
Yeah, like that gun stuff. Like, I can understand that you put new laws in place for weapons, and then like you can't sell a certain type of weapon, but then they're trying to go back and get people that have these weapons to bring their weapons back in. I think you make your laws, you change it so that like people can't acquire this weapon anymore, and then you just use that going forward. Trying to go in and take something that people have already acquired, like you're going to get so much pushback from that. You could do voluntary, like a voluntary buyback program if you really want to get specific types of weapons off the streets, but I don't think you can mandate it like they were trying to.
That's double for consultants. 7% increase in the spending on the national bureaucracy. Over $1 billion in handouts to fake and phony refugees. A 100% increase in spending on corporate welfare. It's all inflationary spending. Will they stop putting it on the national credit card and get rid of it instead?
Even this leader of the opposition, it's pretty hard to say that money that hasn't been spent yet is inflationary.
Right.
We have not yet, although we will be building high-speed rail as part of our plan to build Canada strong, Mr. Speaker.
I honestly think that in most Western nations, a high-speed rail is not profitable. What you get from it is not worth the cost. Like, in places like China, the government can just kind of come in, displace people, and be like, okay, this building has to be moved because we need to build a rail through here. And they could just kind of displace people like that. They build a new building. They can do it for pretty cheap. Here, like, property rights are such a thing, and it's so hard to build a rail through everything. And given how large our country is, and I mean relatively not very dense, it's usually more cost efficient to do flights. Like, any money you'd put into high-speed rail, putting it into lowering like air traffic costs is usually just better. Like, you look at what's happened in California. They were building a high-speed rail between a couple of their cities in California. Project went way over budget, and it didn't even connect to where they wanted it to. Like, you can take it to outside of the cities. Like, what's the point of that? It was supposed to take you to the city, not to like the outskirts of the city. I would largely consider that project a disaster. And that's the closest model we have for high-speed rail in Canada. It doesn't look like it would go well. I would like to see different things done with that money.
But let me keep going on the list. The Canada Workers Benefit, is that inflationary spending? Is it the National School Food Program? Is it Canada student loans? What exactly, in the eyes of the Leader of the Opposition, is inflationary spending? Will he take it?
Okay, I actually kind of like that debate section.
What?
Like, the fact that Mark Carney isn't arguing for it, and he's got like a finance minister or someone out there, I don't really like that, but You did hear his take on it. I am excited for this. I want to learn about Norway's, because they brought it up clearly. Okay, Bloomberg Television or Logically Answered. Let's try Logically Answered.
Have you ever wondered why Social Security is absolute garbage?
Okay, so I'm going to look into the Norway 1.4 trillion wealth fund, because it's clearly what they're trying to imitate with this. So let's see how this
every year they
works
collect
for them.
12.4% of everybody's income up to $18,000. Yet they're projected to fall short of their payouts by 2034. Some people blame it on the pandemic, others blame it on bureaucracy, and others suggest that it's simply a side effect of people living longer than ever before. While all of these are valid points, none of these are the fundamental problem with Social Security. You see,
Why has he jumped into that? He hasn't even explained. Let's try this one. Explain to me what it is first.
This is Norway, one of the wealthiest countries in the world and also the world's largest investor. Its sovereign wealth fund has a massive value of $1.4 trillion, invested across 69 countries and thousands of individual companies. Seriously, the latest holdings report has 398 pages of just an endless list of company names and their ownership percentage. In total, it owns 1.5% of all of the public companies on Earth.
Whoa.
Not to mention, it owns hundreds of buildings in the world's major cities like New York, London, Berlin, and Tokyo. This is very impressive.
I mean, like, hopefully that's not office space. Because the price of office space just absolutely collapsed, from my understanding.
Considering that 25 years ago, the fund only had a value of $300 million, with every single cent invested into low-yielding government bonds. And the country has successfully turned oil, which has long been described as a curse to the nations owning it, into a blessing that enriches both its current and future generations.
Yeah, it's crazy how oil can be seen as a curse when it, like something that's so valuable for a nation to have. What is that? Does this building come up and then hang over a little green area here? I mean, why not?
But the journey is
hopefully you don't live in that little spot that hangs over, because I would be concerned.
Far from being smooth. In the 1980s, mismanagement of the oil revenues along with several bad economic policies caused overheating of the Norwegian economy. Inflation peaked at around 13% in 1981, and then the nation fell into a banking crisis in 1988. Meanwhile, the fund itself was widely...
It is kind of wild that there's almost always a crisis and then the correction. Like, you almost need a crisis in order to fix the system. It just seems to be how it works.
Criticized when it increased its equity allocation from 40 to 60% in 2007, right before the global financial crisis. Despite that, the fund performed better than most institutional investors during that period and has more than doubled in value since 2010. It also brought an immensely valuable safety net for Norwegians, $250,000 for every single person, which I am jealous of. And all of this has been...
So, the Canadian one was specifically for Canadian projects, right? Like, it was an investment fund to invest into Canadian projects. This is an investment fund that has just full access to all of the markets. Like they're saying buildings in other countries and stuff like that, which I mean, probably profitable. What did they say? Doubled since 2010. So I mean, they're doing well.
Achieved while maintaining extreme transparency, good corporate governance, and ethical and responsible investing, making it the most successful and likable fund. So in this video, we'll talk about 3 things. We'll briefly discuss about the Norwegian economy before the fund's creation and how Norway turned the oil curse into a blessing. We'll examine how the fund is organized and managed, its investment philosophy, asset allocation, that kind of things. And we'll talk about how this massive fund benefits the economy at large. Norway's economic success probably started in 1969, when the American oil company Phillips Petroleum discovered lots of oil over the Norwegian continental shelf at Ekofisk, the largest oil field in Norway measured by production, with many more oil fields discovered ever since.
I mean, here in Canada, we're sitting on the 3rd largest oil reserve? From what I understand, it's not easy to access like some other oil, but still like a terrifying amount of oil.
Then the state immediately established a petroleum tax that guaranteed the oil resources found in the seabed would remain public property.
That is something that you gotta do. Like the wealth of the nation does need to be like brought back into the government, because oil can be so profitable that you gotta be careful how you allocate the money from it. I think there should definitely be high taxes on oil, but I also think you should be expanding the oil sector in Canada. And you saw when we read the summary earlier, they did say conventional energy. That's oil. So it does look like the fund will be allowed to invest that way,
keeping the new fund,
which I hope they can,
wealth in the citizens' hands. Suddenly, the nation became filthy rich, and you might think that's the end of the story. But like many other countries that
so many countries that get a boost of income from a resource that they find go through the resource curse, where they find the resource, they get a bunch of money, so they bring the standard of living up, match the amount of money they're getting now, and then the resource either becomes less valuable, it starts to run out, the price of it eventually goes down, and if you've been living basically like you're a person living at your means, eventually the means go down, and that's when you start to see a lot of issues show up, because everything in the society will have been built based off the current value or even a projected higher value, and that's dangerous. I had asked this a question. Did I ever get back to that? My chat. Okay, I lost my train of thought. Let's keep going.
Suddenly had much wealth, it made the same mistake as everyone else did, spending too much oil money too fast. This was worsened by credit liberalization in the early 1980s, while interest rates were at significantly below market level, causing the economy to overheat along with double-digit inflation. This all continued until 1986, when oil prices collapsed. Trade surpluses suddenly became huge deficits, credit began to freeze, and banks began to fail. All of this triggered the 1988 to 1992 Norwegian banking crisis. Until 1990, Norway spent all of its oil revenues, mostly reinvesting it back to the oil industry. But something had to change. So in 1990, Norway created the Norwegian Petroleum Fund, or otherwise known as the Oil Fund, to invest its revenues abroad. Now, there are 2 main reasons why the Sovereign Wealth Fund was created. First, the country wanted to turn oil, which is a finite resource, into a sustainable revenue source for future generations.
And like the sovereign wealth fund is a good way to do it.
Moreover, it wanted to avoid the boom and bust cycles caused by volatile commodity prices. The country learned this the hard way when oil prices collapsed in 1986, dragging the economy along with it. Second, it wanted to avoid the Dutch disease, when sudden inflows of foreign currency on one industry caused the national currency to appreciate, causing exports to become more expensive for other countries to buy, which reduced competitiveness in other industries like manufacturing or agriculture, resulting in deindustrialization. This is exactly what happened to the Netherlands after it found the largest natural gas field in Europe, hence the name. The oil fund solved both of these problems, as investing in securities outside of the oil sector provides diversification benefits that the nation desperately needed. And by investing in foreign assets, the country could slowly absorb the oil revenue, instead of all at once, avoiding the Dutch disease and saving the revenues for...
I mean, that's a nice looking place. Where is this? Like, talk about living on the water. Look at all that waterfront property that's just buildings directly to water.
Future generations. The Sovereign Wealth Fund is key to Norway's economic success, as many resource-rich countries actually became poorer than before natural resources were discovered.
Yeah, like that's crazy. A sovereign wealth fund where you put the wealth from the resources into like a long-term investment. We see Saudi Arabia right now trying to do this. They're building essentially mega projects. Their goal isn't like a sovereign wealth fund where they're investing into like foreign companies. They're investing into like resorts or like the Line project, the mega city, like things that would draw in like foreign capital essentially. So it's similar to a sovereign wealth fund, but I think the sovereign wealth fund is a much easier way of doing that. They're trying a much more complicated way, and I guess we'll see if it works out for them. Like right now, that whole area is in a war, so there's not a lot of foreign capital going there. But assuming we get to peace and these things are constructed, they might be successful. We'll see.
Unlike other countries though, Norway learned from its mistakes and began thinking about the future, rather than rushing to use its oil money immediately.
Didn't they just say there was a crisis? Like, they did rush to use their oil money immediately, but they've learned.
This is the kind of long-term thinking that we desperately need in politics. Now,
I'm hoping that our government learns too.
The fund is obviously the most successful sovereign wealth fund in the world, and it made Norway one of the world's richest countries. But how does the fund actually work? The GPFG, or Government Pension Fund Global, is administered by the Ministry of Finance, which sets the fund's goals, regulations, and strategies. But the fund itself is operated by Norges Bank, the Norwegian central bank. Now, unlike its name, the fund is not a pension fund. The assets inside the fund aren't used for a specific purpose like providing for retirement or healthcare, although it could if the government wants to. So, no person or organization has a direct claim on them. Instead, the fund is used by directly transferring the money into the state budget, which then flows right into the Norwegian economy. To sustain the fund's value, the finance ministry limits...
That's a cool building. What are these people all doing today? What's the purpose of this area? Like, literally just to stand there and take pictures?
Withdrawal from the fund at 4% annually, because 4% is the long-term expected return of the fund. You might have heard of the 4% rule if you're into early retirement. The concept is similar to that. In 2017, they revised this to 3% because the fund was getting bigger. This arrangement is pretty flexible though. In good times when tax revenues are high, like in the early 2000s, less than 4% of the fund will be transferred to the state budget. In bad times like late 2008 or early 2020, more than 4% of the fund will flow to the economy to minimize the economic damage.
So, they have a sovereign wealth fund, and 4% of it a year. So you assume it grows by like, I don't know, what do you expect? Returns like 10% a year on average, right? You take 4% of it and you put that into the national budget. They're down to 3% now because it's gotten bigger. They add that to the national budget, and anything left, like any other growth, is just added to the fund. So then, are they not actively investing into the fund? Wait, let me hear that last little section.
Budget. In bad times like late 2008, like in the early 2000s, less than 4% of the fund will be transferred to the state budget. In bad times like late 2008 or early 2020, more than 4% of the fund will flow to the economy to minimize the economic damage. This is such a valuable safety net for Norwegians, as most countries do not have the luxury of pulling money from a 1.4 trillion oil fund during an economic downturn. In this situation, most countries will likely take on more debt or print more money to provide stimulus, which does work but have damaging side effects.
Yeah, like having the fund just gives you another option. You don't have to take the debt option. And it's the debt option that eventually causes you so many problems.
Therefore, the fund acts as a fiscal policy tool, and a very effective one at that, at least for Norway. Okay, so Norway has massive oil wealth, and it invested that wealth into more wealth that made the nation filthy rich. Pretty simple. But how does the country invest this money? After all, it's pretty much useless if they don't invest it well, and managing a $1.4 trillion fund is far from easy. So, let's look at how the country invests its oil money. The Norway model for investing is characterized by its long-term belief and low management fees. The country wants the fund to be sustainable and to gain a permanent income from it if possible. Coupled with the fact that Norway is a rich country in its...
That's the idea. Use a large-scale but short-term wealth generation. Use that, put it into a fund that provides consistent returns over time, and then use that to assist the nation rather than trying to spend all of the short-term money. Like it's just good fiscal policy.
And the fund has no outside shareholders, makes it far more tolerant of volatility and short-term capital losses than most investors. This is why 72% of the fund's
if you win the lottery, you don't go out and spend all your money instantly. You put a lot of it probably into the market where it can continue to get you returns so it can fund the rest of your life, right? And the people that go out and spend it all instantly, those are the crash outs you hear about.
Portfolio is concentrated in equity, which is pretty insane if you think about it. But this wasn't always the case. Before 1996, the fund pretty much invested exclusively in government bonds, which were expanded to a 40% equity and 60% debt allocation. In 2007, the fund decided to primarily invest in stocks, 60% of the total portfolio. At the time, this was widely criticized because 2008 was a bad year for investors, including Norway's oil fund, which was down over 20%. But in 2009, it recouped all of its losses with a 25.9% return, which is the fund's largest return in a single year. Other than stocks, 25% of the fund is invested in fixed income assets, comprised of government and corporate bonds. Another 2.5% is invested in real estate. The fund first entered the real estate market in 2010, when it acquired 25% of the Crown Estate's properties in Regent Street in London. Since then, the fund has purchased properties in countries like Germany and Switzerland. It also entered the US real estate market in 2013, making investment in New York, Washington DC, and Boston. In 2017, it entered the Asian real estate market starting in Tokyo. Also recently, the fund has invested in renewable energy, but this makes up for less than 0.1% of the portfolio. If you notice, Norway uses a simple but peculiar strategy. Usually when you look at institutional investors, you will see a significant part of the portfolio dedicated to exotic assets, like private equity for large returns or gold as an inflation hedge. The reason Norway doesn't invest in these is because its size is too big for private equity investments to add meaningful value, and it doesn't really need an inflation hedge as long as it still has lots of oil under the sea. For the fund, deflation is far more worrying than inflation. Okay, so 70% of the whole 1.4 trillion portfolio is invested in stocks. But what kind of stocks? The fund has over 9,000 stocks in 69 different countries for diversification, so it's hard to truly explain this in a video. But roughly, the equity index comprises of 50% European stocks, excluding Norway, 35% American, Middle East, and African stocks, and the remaining 15% are invested in Asian and Oceanian stocks. Some of the biggest names I found include Apple, Amazon, Unilever, Microsoft, and Visa. I'll link the full report in the description. For fixed income assets, roughly 60% are European, 35% US and Canada, with 5% Asian and Oceanian assets. Now, you might wonder why most of the investments are concentrated in Europe. This is partly because of currency reasons. All investments are unhedged and the Norwegian kroner exchange rates have in the past been less volatile against European currencies than against non-European currencies. The fund also has some strict ethical standards. In August 2020, for example, it excluded India's Page Industries, a manufacturing company that had reports of human rights violation in one of its factories. And the fund excluded 4 Canadian oil and gas companies: Canadian Natural Resources, Cenovus Energy, Suncor Energy, and Imperial Oil, that produces too much greenhouse gas emissions. Companies that control assets or receive more than 30% of their income from thermal coal will also be excluded from the fund. Norway has been a lucky country. It found large amounts of oil right before oil prices soar. But what differentiates Norway from other resourceful countries are its long-term thinking and prudent management, which
that it didn't have in the beginning, that it acquired after a crisis. But it did get there, and it does work.
Fortunately, not many countries have. And its massive sovereign wealth fund is key to understanding how Norway is so successful. Now, a country that has tried its best to instill this long-term thinking and prudent management is China. But so far, it has not been successful as a massive property bubble emerged and became a full-blown property market meltdown.
That was pretty good. Their fund clearly has far more leeway into what to invest into. The Canadian fund sounded like it was going to be specifically for Canadian investment, like to invest into the Canadian sector. I think that's better, but I don't know. Like you need to fund the funding a factory in your own country will provide more economic benefits than funding a factory just somewhere else in Europe, right? For your own country. Because it provides jobs, provides spending, like it advances the economy in your own country. But limiting it to just Canada will limit the growth of the fund. Like the one that we just saw, Norway has access and can clearly invest into all of Europe or pretty much all the world because they had Asia. They were even involved in like Tokyo real estate. They were able to invest anywhere. So that allows you to get better returns. But I don't think the idea of this specific fund is essentially to get the returns, it's to get the infrastructure projects built in Canada. I don't know. Like, I think it's a good idea. It does come down to the details for me. And we'll see the economic statement tomorrow. Oh, that's the question I was asking. Well, fun. How to phrase this? Did I ask this one? Ooh, yes, right here. This is what I was looking for. So, the International Monetary Fund has stated that Canada is in the best fiscal position of the G7. Can you go into more detail for me? All right, here we go. The International Monetary Fund, IMF, has consistently ranked Canada as having the strongest fiscal outlook in the G7, primarily due to its low net debt to GDP ratio. That's what we were looking at, net debt to GDP, like 41% or something. And its relative growth prospects. From my understanding, growth is really low, but there are good growth prospects. While domestic headlines often focus on rising gross debt or deficits, the IMF looks at the broader balance sheet. Here is the detail behind why they view Canada's position so favorably. The lowest net debt metric. This is the primary reason for the IMF's high ranking. Unlike gross debt, net debt subtracts financial assets like the massive holdings in the Canadian Pension Plan and Quebec Pension Plan from total liabilities. Canada's position. Canada has maintained the lowest net debt to GDP ratio in the G7 for over 2 decades. The numbers. In 2025-2026, Canada's general government net debt is approximately 15 to 16% of GDP. For comparison, the G7 average often exceeds 90%, with countries like the US, UK, and Japan carrying significantly higher net burdens. Canada's general government debt is approximately 15 to 16%. We have a really high household debt in Canada too. But like that, I think a lot of that is housing costs. You go into a mortgage on $1 million house, you got $1 million debt, right? The IMF forecast suggests that Canada is positioned to grow faster than most of its peers. Position. Not that we are. We have second fastest growth for 2026. The IMF projects Canada's economy to grow by roughly 1.5 to 1.9%. This is typically the second fastest in the G7, trailing only the United States and outpacing Germany, Italy, and Japan. Population drivers. This growth is heavily supported by Canada's high population and employment growth rates, which the IMF notes are the highest in the G7. The high population growth is immigration, which the IMF notes is the highest in G7. Okay. The AAA credit rating. Canada is one of the few countries, alongside Germany, that has maintained a AAA credit rating from most major agencies. Borrowing costs. This rating signals to the IMF that Canada's debt is highly sustainable. It It allows the government to borrow at lower interest rates than countries with lower rating. Fiscal buffers. Because the debt to GDP ratio is lower than its peers, the net debt to GDP ratio is lower than its peers. The IMF argues Canada has more fiscal room to respond to unexpected economic shocks, like a tariff war with the US, like a recession or a housing market correction, without risking insolvency. Conservative deficit management. Despite recent increases in spending on infrastructure and defense, the IMF notes that Canada's annual deficit as a percent of GDP remains relatively modest compared to the UK or the US. Fiscal guardrails. The government has largely struck to a fiscal anchor of keeping the federal debt to GDP ratio on a declining path over the medium term, a move the IMF has praised as an effective anchor for market confidence. I mean, that's just keep the federal debt to GDP ratio on a declining path over the medium term. That's just a good idea. I think they were expecting an increase in the short term, but as long as the outlook is you're still pushing the debt to GDP ratio down, like debt is what gives you. In Norway, they have the sovereign wealth fund that they can use to kind of ride out the bumps in the market, right? Most governments do not have that. They ride out the bumps in the market by debt. They'll use the debt on a downturn, push it up, and then you're supposed to pay the debt off on an upturn. And so it kind of evens out. But for most countries, this continuous use debt and then pay it back is trending downwards. They're losing money over time as the debt gets bigger, and then the requirement to pay the debt, the interest becomes a larger and larger aspect of the budget. Like, what is it? Isn't interest larger than the military budget in the US now? That's you could double your military if you didn't have the debt. And you're not even paying the debt back with this payment. The Trump's big beautiful bill increased deficit spending. The debt is getting larger. And you're spending this much just to service it already. I think that's going to be dangerous there. All right, the fine print. This is the bottom of it. Okay. It is worth noting that the IMF praise focus on the federal and social security levels. They do occasionally flag risks that are unique to Canada. Subnational debt. While the federal government is in great shape, Canadian provinces carry significant debt compared to subnational governments in other G7 countries. Household debt. The IMF often warns that high Canadian household debt, mostly mortgage, is a potential vulnerability that could dampen the growth they are forecasting. In short, the IMF assessment isn't saying Canada is without problems, it's saying that compared to the rest of the G7 neighborhood, Canada has the most solid foundation and the most room to move. We're not saying you're good. We're saying you're the least bad. How does this compare to what you've been hearing about the domestic economy lately? I've been hearing negative things about the domestic economy, but the government appears to be in a decent fiscal position. Provinces, large amounts of debt. I hear that provinces are in a large amount of debt in Canada. What provinces are under the most strain, and what are their approximate debt amounts? Let's go. Will you listen to something still? No. I gotta post this. Post the video. Listen to Dover Hill. I think that worked. Let me just check. Good. So, YouTube, when I specifically chat through it, doesn't count that as a chat. But when I chat through OBS, it does. Okay. Interesting. Okay. Close. I wanted to look at this. Let's just finish this up. While Canadian federal government has a relatively strong balance sheet, the provinces are indeed under significant pressure because provinces are responsible for the most expensive public service, healthcare, and education. Their debt levels are much higher relative to their revenues than the federal government. As of the 2026 budget cycle, here are the provinces under the most strain based on two key metrics: net debt to GDP, that's the one we like to look at, and absolute debt. Oh, what's up? I will stream whenever you go live because you add me on Discord. I'll look into doing that maybe after the stream. Thanks for checking out, though. The most strained by debt to GDP ratio. The debt to GDP ratio is the best method of fiscal strain because it shows how much of a province's economy output will be needed to pay off its debt. Here we go. Newfoundland, 45.6. These aren't that bad. Consistently the highest in Canada. Small population and volatile oil around make this debt very heavy per capita. Quebec, 38.8. Clearly, provincial debt is treated differently because federal debt, from my understanding, the big no-no number is 70%. Like net debt to GDP, you go over 70%, it starts to massively negatively impact growth within your economy. But they call these high and they're 45, so provinces probably have lower ability to borrow. Manitoba, Ontario. I mean, like, there's a bunch that are right around 30, 38, 37. Massive capital spending on transit and highways is pushing this ratio higher after several years of decline. By absolute amount. Okay, Alberta. Let's have a look here. 51.4 billion despite recent deficits due to softer oil prices. Alberta remains in the strongest position with debt to GDP ratio of only 10.5. That's nice. I would have liked a sovereign wealth fund. Can you create a sovereign provincial fund? For when, like, I don't know, let's just say oil prices spike because maybe there's like a war affecting the oil price, and then we can put that towards a sovereign fund. That way we don't have to use this, and you just use the fund to control the necessary spending. I'm just saying, it worked for Norway. It could work here. Why the strain is increasing in 2026. Provinces are currently caught in a triple squeeze. Yeah. Making their debt harder to manage. The interest bite. As older debts mature, provinces are refining. Oh, so they're going through the same thing households are going through. Low interest rates during COVID. Spend money to solve the problem. And the interest rates go up, and then all of a sudden you have to deal with the money you spent. Now there's consequences. Population growth. Rapid population growth has forced provinces like Ontario, BC, and Alberta to spend billions on new schools, hospitals, and transit to keep up with demand. That just happens with the population expansion, right? As your population, I don't know if it's gonna keep growing. Tell you the truth, like there's this new push to lower the mass immigration, essentially. And we see the immigration rates coming back down to something more sustainable. And the fertility rate in Canada is going way down. Like, if you bring the immigration rates back to something normal, you'll probably see, I mean, I don't know if you'll see population shrinking, but I don't think we'll see the same population growth that we've seen in the past. Which means we won't have to spend more to expand schools, hospitals, and transit. Healthcare costs and aging population is naturally driving up the cost of single largest item in every provincial budget. That's gonna keep happening. Like, we need the robots that do the surgeries. Like, where are we at with that? I saw they're coming along. Like, this is not far off. Where you're probably better off having a robot do it than a person. But I mean, like, 15 years away. But I mean, hopefully that lowers the cost of healthcare, which is the biggest provincial budget. Even then, like, none of these are like unfixable. Okay, what was the other one it was talking about? Household budgets, right? What's the average household debt in Canada? I'm gonna see if I can't get a chart for this. This one trading economics. I love this study. How do I go back 10 years? Ooh. Okay. What are we looking at? Household debt in Canada increased to GDP in the fourth quarter. So this is total household debt. The issue is here, like, when we look at the federal government, we do net debt, right? So do we want to look at net debt? Because, like, a lot of this debt is offset on your balance sheet by the house asset, right? You have debt, you have your mortgage, which is the primary debt, but then you have your house, which is worth that. Let's see what the AI says. The average household debt in Canada has reached a significant milestone in early 2026. So it has, like, this was the pandemic, right? We had a massive increase in debt. I think that's because money went cheap, right? Interest rates dropped, money went cheap, borrowing became easy, people borrowed. Simple incentives. Money became more expensive, borrowing dropped. Sitting at over 100, which I mean is not good from my understanding. Okay, the big picture numbers. Average total debt per household, approximately 176,000 to 180,000 Canadian. This includes everything from mortgages and car loans to credit card balances. Total national household debt, roughly 2.65 trillion Canadian. That's a lot of debt. Debt to disposable income ratio. That one sounds important. 176.9. This means that for every $1 of disposable income a Canadian household earns, they owe roughly 1.77 in debt. So yeah, because people don't make that much a year, right? The average income. So for every dollar you make in a year, you would owe 1.77 of that in debt. While this has stabilized slightly from the peak of previous years, it remains among the highest in the G. Like, this is the cost of living crisis, right? This is where you see it. Breakdown by debt type. Debt isn't distributed evenly. Most of the weight is in housing. Yep. But consumer debt is where many families pay at least. So mortgages. Ooh. Non-mortgage, just consumer debt. Average amount per household. Per household with this debt. So this isn't. So these are people that have this type of debt. Like I don't have credit card debt. My credit card gets paid off the moment I use it, so that they don't charge me interest. The bastard. Mortgage, non-mortgage consumer. This includes credit cards, auto loans, and lines of credit. So if you have this type of debt, then you're on average 23,000. Like, that sucks. A lot of money to be behind. And like, this is the kind of debt where your credit card, your auto loans, your lines of credit, well, I don't know about lines of credit, but credit cards and auto loans, like that's the high interest types of debt. Like mortgages, you can usually get a decently low rate at. The credit cards, they charge you at the wazoo, man. That's rough. Regional variations, okay. Summary. While the IMF likes Canada's government's balance sheet, they remain concerned about this household balance sheet. Canada's government is rich, but its citizens are some of the most indebted in the developed world. Does this level of debt align with why you're seeing? That's crazy. So we have a federal government that has good finances. Provinces, like, I don't think that was a big problem on a large scale, at least. The household debt, though, like, that is kind of scary. If you take out the mortgage, which, I mean, when you get a debt for a mortgage, you get an asset for the same thing, or at least you were. Now that asset is it house prices 10 years, I mean, like, it's still going down. You buy a house right now, you might have to factor that slow decline in. And this is largely from specific areas of the country, like Toronto, where you're seeing the decline. My understanding is that Alberta is still actually seeing price increases, although Calgary might have caught the Toronto virus, the condo virus, or whatever they call it.